The U.S. bank regulator, the Federal Reserve, released the results of two sets of examinations called stress tests, more awkwardly known by their official names, DFAST and CCAR. The pure quantitative results from DFAST were released last week. All 33 of the largest U.S. bank holding companies under review passed the test. This meant that they would have sufficient capital to withstand a so-called severely adverse scenario, a hypothetical catastrophe that is adjusted from year to year. This year, it included a scenario where unemployment doubled to 10%, the stock market took a nosedive, and most interestingly, interest rates flipped to negative. The more interesting results were delivered late on Wednesday in the second phase called CCAR, which includes a qualitative review that touches on the bank's risk management, internal controls, and governance. All of this culminates in what investors care about most: how much can banks pay out in dividends and share buybacks? If shareholders are most interested in the cash coming their way, perhaps bank bosses are most worried about not being publicly humiliated by a failing grade. In that sense, Wednesday's results were good. 31 of 33 institutions had their capital plans approved by the Fed, including traditional laggards like Bank of America and Citigroup. The two failures were U.S. subsidiaries of European banks, Deutsche Bank and Santander. It was the third consecutive year that the Spanish bank did not satisfy the Fed, and the second straight black mark for the German firm. Morgan Stanley also got a warning about its internal risk management. But for the rest of the group, it was party time, as it is estimated that capital return will reach $96 billion, nearly a fifth higher than last year. Citigroup alone was tripling its dividend. The irony for most banks is the stress test day may be the highlight of the year. Interest rate hikes they need to boost net interest margin are not likely to materialize anytime soon, as the global instability will keep the Fed in check and stock prices will suffer. But with $700 billion of equity raised since the financial crisis, institutions are as solid as they have been in years. That's good news for depositors, creditors, and regulators. Shareholders, however, will have to wait patiently.